I'm Gwen Preston of Resource Maven, and I'm here guest hosting Beneath the Surface. We're at the Cambridge House Investment Conference in Vancouver, and I've got John Kaiser with me. And John's kindly agreed to sit down for a chat about where the markets are, what they need to do in order to move forward a bit, and gold. So let's start with maybe the downside, which is the venture exchange. It's clearly had its challenges, both from a metals markets perspective over the last few years, and you've been talking a lot about some more systemic problems in the venture exchange. So can you just speak to that a bit?
Well, we are in now entering the fifth year of a cyclical downturn, and the core narratives, which is sort of the commodity cycle, the gold narrative, security of supply, and discovery exploration, all of them are in a very poor mode for arguing for a rapid turnaround for this bear market. We have probably bottomed for the better companies. The uncertain question is, how long do we motor along at a bottom? And it may be another couple years. Now, your other question about the systemic problems is that although the downturn is partly cyclical, there are structural reasons as to why this time may be different. The money that drove the last cycle, it was sort of super cycle, and while gold was ascending, the gold bug cycle, to a large degree that was institutional money. That money is now not very interested in the sector. So the more advanced companies which are doing feasibility demonstrations on their projects, they are being starved for capital to advance their projects. They cannot get that from retail. And the discovery exploration juniors, which have normally nourished this sector during cyclical downturns of the macroeconomic variety, the retail investor is alienated by the trading culture that has emerged, where prop traders literally hover over the market, monitoring for capital inflows, harvesting them through short selling strategies and so on, sucking the money out and not allowing the recycling to happen. But an even bigger problem is that the client relationship model that the regulators have introduced, because they have concluded that the financial sector has an intrinsic conflict of interest with regard to their clients, they've introduced this suitability requirement to limit the ability of investment managers, fund brokers, and so on to advise clients. And so there's a de facto ban on even accepting unsolicited orders to buy a junior. And private placements are the only mechanism, and even though you're an accredited investor, you are no longer being allowed to rely on your broker to find the juniors where you want to put money in. So we've seen an evaporation of the channels by which money flows into the junior sector, and it literally will starve to death because the financial sector is changing in ways that will never be reversed. And I'm arguing that they need to abandon the accredited investor restriction to allow, at least in cases where no intermediary is being compensated, to allow any investor to put money directly into treasuries through private placements. That's how we can start feeding the juniors from the bottom up, giving them the basic fuel to go out there and make the discoveries that rekindle the junior resource sector in bear markets like this, where there isn't a big ascending gold price or copper price to pull in the bigger money.
Absolutely. So, and I mean, metals, you have seen many cycles, I've seen cycles. Metals are intrinsic, essential to how we live life. They're in these bear markets. Production gets cut back, capital development gets cut back, exploration gets cut back. So it has to turn. That's why mining is so cyclical. But if there aren't retail investors there, then the whole premise of that upturn is put into question. So,
well, I mean, the last decade, when China came on stream as a rapidly growing economy, caught the mining industry by surprise, and we had substantial real price increases in the metals, and the juniors rose to the occasion, pulled all these failures from past exploration cycles out of the closet, dressed them up and said, hey, these work. And the institutions loved this scenario. They loved the China story. And the mining industry has been very effective in mobilizing a supply response. If you look at the amount of all the major metals and even the more obscure ones produced in the last decade, many of them have increased 50 to 100%. But now we are seeing global economic growth stalling. The nature of China's growth is changing. And so we have a period of at best metal supply and demand being in balance, or at worst the traditional boom-bust cycle where as the economy slows, the mining industry overdoes it, gluts the market, busts the price, and we end up with like iron back to $60 and so on. And these conditions are not going to turn for probably another 5 years. India is the next major big economy to ascend, but it will take 5 to 7 years to engineer a shift in the way the bureaucracy there works so that that country can start to grow again.
So if we're looking at a sideways cycle right now, some companies, sideways is made up of some companies gaining, some companies not doing well. The same will be true of various commodities. Some will rise, some will not do so well. If the end result that you think of that is going to be a sideways situation for the next few years, how do we find opportunity in there? Because we can't wait a few more years for profit.
If you are interested in the more advanced companies, half of the ones that were made available in the last decade have been taken out at pretty good premiums, and those projects are sitting there in the pipeline awaiting a production decision. The other half are the ones that either weren't developed enough or had other problems associated with it. The majors soaked up $140 billion worth of juniors, 200. Nothing like this has ever happened to this Canadian sector. And if you are a patient investor, you can now look at what remains and look at the economic studies, figure out what is the price, the metal price needed for this to be worth being taken over. And then you buy these companies as options. The downside is that if this bear market is prolonged, most of these projects have holding costs. The company's price diminishes, shrinks lower and lower. And then long-term private equity investors or even some of the bigger companies will come in and make a takeover bid, which will have startling 300, 400% premiums, like from 10 cents to 40 cents, like happened with Duluth Metals, but 40 cents is still 80 to 90% down from the peak. So if you're coming in and looking for these ones where there are not horrible problems, you can buy them and maybe make 200, 300% over the next couple years. And that's of no consolation to the existing shareholders, but it is a bottom fishing opportunity for these advanced companies that have been stranded by this end of the super cycle.
Absolutely. And you've talked about supply and demand for lots of commodities going forward. Gold is usually a little bit outside of that conventional conversation. It's not an industrial metal. So here's the classic question that everybody always gets. What do you see ahead for gold?
Well, the gold bug narrative that has dominated in the past decade had sort of an ideological foundation, market fundamentalism, if you will, and it's all been premised on the idea that the practices of the major governments are going to lead to monstrous debt expansion, resulting in hyperinflation or relative currency debasement. And of course, the target has been the United States, the world's biggest economy. And so there's been predictions of $5,000 gold and higher. And it's been a bit of a false mapping to this resource production and development sector, because that's really all about profit margin. So if you have currency declines or hyperinflation driving up the nominal price of gold, you don't get the real price increase needed to make these assets profitable. When gold was up at $1,900, if you inflation adjust gold from $400 in 1980 to the present, it should be about $1,120, $1,150. At $1,900, that was a 40-50% real gain, and that was quite exciting. A lot of these projects would make a lot of money if gold stabilized at that level. But if you have a world of growing prosperity and you have increasing desire of this expanding wealth to hedge some of itself in gold, at $1,200 gold, the price is not sustainable insofar as the people who already own gold don't want to sell gold.